Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and today's lesson we're going to be going over how to report other types of income on your tax return. Now, this is the last video we have on our reporting income series, so I encourage you to check out the other videos. They'll be linked in the playlist on my channel. And as always, the guided notes will be linked in the description down below for you to follow along and stay engaged and practice with some of the material that we're going to be going over today. All right, with that, let's get started. So, what types of other income are actually classified as other income? Well, this is income that doesn't have its own line on Form 1040, which is your annual income tax return. And what does have lines is usually basic forms of income that you've heard about, such as retirement income, wages, interest, tips, dividends, that sort of income. If you want more information on the other sources of income, go to my channel or click the links that I've linked on this video at the end for other videos on other types of income to clarify any questions you might have. But other income is basically any income that isn't already explicitly stated on the tax return. And where it's reported is you're going to be reporting other income on Schedule 1. So some examples of other income include prizes and awards, gambling winnings, lotteries, raffles, jury duty pay, which we will go over more in one of our future lessons on adjustments to income. Other types include recovery of a deduction claimed in the prior year, non-business credit card debt cancellation, HSA distributions that aren't used to pay or reimburse for qualified medical expenses, and one other thing is qualified Medicare payments. Now, you might think qualified Medicare payments would be included in other income, but they're not. So I just wanted to include that for clarification. Even if there's no income document, though, the taxpayer is still required to report that income because it's taxable. You haven't paid tax on it. It's income coming in, raising your gross income, raising your adjusted gross income. So you're going to need to pay taxes on it. So you have to report it even if you don't have a document that has the reporting on it. Okay. So one of the main types of other income is the cancellation of debt, which is, as we go into further, non-business credit card debt. And canceled debt from non-business credit card debt or other liabilities must be included on income unless it qualifies for an exclusion. And this is when you might have a gift, bequest, or certain exclusions for main homes. Even if no cash is received, the canceled debt is still taxable because it relieves the taxpayer from the obligation to pay, which benefits them financially. If this doesn't really make sense, think about it as in you have this large credit card debt bill, meaning you charged up that credit card and you can't pay it back anymore. So say you have like $300 you still owe to the credit card company, and you're like, oh man, I just can't pay it. I just can't pay it. That $300, if you write to the credit card company, sometimes they'll offer you a deal. Be like, hey, we still want money for that $300 that you spent that was ours. So if you just pay $200 of it, we'll cancel that 100. And that 100 is treated as income because it's it's money that you should have paid, but you didn't end up having to pay. And that's cancellation of debt. So that $100 that they were like, oh, we got it, it's on the house, did you just pay your 200? That's still taxed as income, even if you didn't actually receive that cash, even if it was that settled agreement. Lenders usually issue Form 1099-C for canceled debt of $600 or more. In this case, taxpayers will have the document and they must report it on their tax return. So taxpayers will come in, and if you're working with a volunteer income tax assistance program site or VITA site, the VITA intern will take that form and they'll enter it into TaxSlayer on your return. Certain student loan debt discharged between 2021 and 2025 is excluded from gross income, so the form won't be issued in such cases. However, since it's excluded from gross income, you won't be directly taxed on it, which is really cool. So if the taxpayer was solvent, though, meaning their assets are greater than their liabilities before the debt cancellation, the full amount must be reported as income. If they're insolvent, it's usually out of scope for a VITA tax preparer to do. So if you're a taxpayer wondering, hey, I'm insolvent, but I want to see if a VITA site could still do my taxes for free, we would refer you to a professional taxpayer, and we encourage you to seek help from a professional taxpayer because it's just too complicated for a VITA site to do it, as we're just volunteers. Another type of other income that we go into a lot of depth in this lesson is worldwide income. And this is when U.S. citizens and resident aliens have income coming from foreign countries. Their U.S. citizens and resident aliens are required to report worldwide income on the tax return, regardless of where they actually live and if the income is taxed by the country of which it's earned. They can, however, claim potential benefits when they're living abroad. Income is treated as the same on the return regardless of the country from which it was derived. So, speaking of this, we are talking about exchange rates. So, all amounts, when you're reporting it on the US return, they have to be in US dollars. So, if you're receiving income from a foreign country that uses a different type of currency, you're going to need to convert that to US currency using exchange rates, which you can really do by Googling on a calculator, like exchange rate euros to dollars or exchange rate pesos to dollars. It's pretty easy, or you could do the math. Either way, up to you. So, one benefit of having foreign income, or not really benefit, I should say, but one thing that happens when a taxpayer has foreign income is that they might qualify for the foreign income exclusion. And certain taxpayers that exclude income earned abroad using Form 2555, they're able to exclude their foreign income on the U.S. tax return. However, this always isn't the most beneficial option because when you take the foreign earned income exclusion or the FEIE, you will be sacrificing being able to take the earned income credit on the U.S. return or the child dependent credit. So, yep, or the refundable part of the child tax credit, like we mentioned. So, to qualify for the foreign earned income exclusion, taxpayers must prove that their home is in a foreign country, number one, either meet the bona fide residence or physical presence test, number two, and have qualifying foreign earned income. And these are three tests to get the foreign earned income exclusion that we're going to be talking about throughout this lesson. Once chosen, the exclusion remains in effect for future years unless you revoke it. And the taxpayers can't claim it again for the next 5 years. So if you revoke it, you have to wait 5 years before invoking it again. Okay. So we're going to be talking about the first test to claim the FEIC. And this is where the taxpayer's home must be in a foreign country. Defined as a country where the taxpayer is permanently or indefinitely engaged to work as an employee, regardless of where the family home is maintained. And this goes into what a regular place abode is. And in order to determine if you had a regular place abode, you'd ask the question to the taxpayer, did you use your home in the U.S. as a residence while you worked at your job in the U.S. just before going abroad to your new job? And did you continue to maintain work in that area in the U.S. during the time you worked abroad? Another question you would ask is, are your living expenses duplicated at your U.S. and foreign homes because your work requires you to be away from your U.S. home? And the third question you would ask of the taxpayer is, do you have a family member or members living at your U.S. home, or did you frequently use your U.S. home for lodging during the period you worked abroad? And based on their answers to those three questions, you're going to determine if they're one of three vocab words. So indefinite assignment is if the taxpayer would say no to 2 out of the 3 questions, then the taxpayer is indefinitely assigned abroad. If all 3 of the questions were answered yes, and the job is less than a year with a return to the U.S. home, then the taxpayer is only temporary away, and it's called a temporary absence. And if the taxpayer only said yes to 2 out of the 3 questions, and there's a planned return to come to the U.S. home, the location of the tax home is determined based on specific circumstances. Okay, so period of stay. So the period of stay is the amount of time that a taxpayer stays in a foreign country. A U.S. citizen or U.S. resident alien from a tax treaty country who is a bona fide resident of a foreign country or foreign countries for an uninterrupted period that includes the entire tax year, or a U.S. citizen or U.S. resident alien who is physically present in a foreign country or countries for at least 330 full days during a period of 12 consecutive months. So this is kind of like the presence test that we had in the resident or non-resident alien lesson really early on in the channel. I think it was unit 1. So you need to determine the period of stay, if they're actually living in the foreign country, if they're living in the US. And this segues right into the second test that you need to do in order to determine if the taxpayer can claim the foreign income credit. And that is either they pass the bona fide residence test or the physical presence test. And the bona fide residence test is, to meet the bona fide residence test, taxpayers must establish permanent quarters in a foreign country for the entire tax year, even if they plan to return to the US. Simply working abroad for a year or more isn't enough, though. Taxpayers must establish a residence in the foreign country. Short trips to the US won't disqualify, but if their intention to return to the foreign country, it must be clear in order to pass the bona fide residence test. Now, if the taxpayer doesn't pass the bona fide residence test, you move them to see if they pass the physical presence test. And to qualify under the physical presence test, taxpayers must be physically present in a foreign country for 330 full days within a 12-month period. Only days spent entirely in a foreign country count towards the requirement, meaning you're not counting travel time, you're not counting flight time. The taxpayers can move within or between foreign countries without losing full days. If travel time takes less than 24 hours, the time is spent in transit and is considered to be in the foreign country, like we mentioned. Okay, so once you determine, yes, they passed either the bona fide residence test or the physical presence test, you move to the last test. I know this is a lot of tests, but you move to the last test of determining what types of if they qualify for the foreign earned income credit test. If they qualify for the foreign income credit test. And that's if they have qualifying income. And this is income that must be earned income for services performed in a foreign country. This is not passive income. This is earned income, meaning it does not include dividends, Social Security benefits, interest, pensions, capital gains, annuities, alimony, none of that. It needs to be earned income, meaning you are working for your wages. That is earned income. All right, I know this lesson was a little heavy, but these are some of the most common types of other income you're going to be seeing as a VITA intern, or if you're a taxpayer, or these are some of the types of other income that you can take to a VITA site to help get your tax returns prepared for free. All right, I hope you guys learned something. Have a great day. See you next time.